Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Okay, so if you're self-employed in Canada, you know the feeling, right? You open up Form T2125, the statement of business or professional activities, and it just stares back at you. It can feel a little intense. But what if we could flip that? What if we could turn this daunting form into a tool that actually empowers you, one that helps you really understand the health of your business? Well, in this explainer, that's exactly what we're going to do. We are going to crack the code on the T2125 together. Here's our roadmap. We're going to tackle this thing in 6 manageable chunks, following the exact flow of the form itself. We'll start with the basics, just telling the government who you are. Then we'll jump into the money, what you earned, what you spent. We'll even get into those trickier sections like capital assets and home office expenses. And finally, we'll bring it all home and calculate that one number that really matters, your net income. All right, first things first. Before we crunch a single number, we have to get through part 1, identification. Now, this section is all about telling the Canada Revenue Agency, or CRA, who you are and what your business is all about. It might seem like just filling in boxes, but trust me, getting these details right from the very beginning is absolutely crucial. So you'll see all the standard stuff here. Your name, your address, your fiscal period, which for most sole proprietors is just January 1st to December 31st. You'll also need to find a 6-digit industry code that best describes what you do. You can find lists for those online. But here's the most important rule for this whole section. If you run more than one business, say you're a graphic designer and you have an Etsy shop, you need to fill out a separate T2125 for each one. That is a non-negotiable, so remember that. Okay, so the CRA knows who we are. Now for the fun part, let's talk about the money you made. This next section is all about calculating your gross income. You can think of this as the top of the mountain. It's every single dollar that came into your business during the year, before we even think about subtracting any expenses. This is your top line. Right away, you'll see the form presents a fork in the road. It asks if you have business income or professional income. It's actually simpler than it sounds. If your business is about selling things or providing a service like a trade, you're in Part 3A for business income. If you're a designated professional like an accountant, doctor, or lawyer, your fees get reported in Part 3B for professional income. And, you guessed it, if you happen to have both types, you're going to need 2 separate T2125 forms. To make all of this feel a bit less abstract, let's follow a real-world example. Meet Alex. Alex is a freelance web developer. His work falls under the professional category. Over the last year, Alex's business did pretty well. He billed a total of $90,000 in fees. We're going to use his journey to walk through the rest of the form. So Alex invoiced $90,000. But, and this is a big but, that's not the number he actually reports as his income. Why not? Well, because a chunk of that money isn't really his. It's sales tax that he collected on behalf of the government. Since he's a GST/HST registrant, he first has to subtract the $4,500 in tax he collected. After that one simple step, we're left with his actual adjusted gross sales, $85,500. That's the number that goes on line 8,000, and it becomes our new starting point. Okay, now for the part everyone loves, expenses. We've established our income, and now we get to start chipping away at it. Every single dollar you spent on a legitimate business expense helps to lower your taxable income. And of course, a lower taxable income means you pay less tax. Part 4 of the form is basically a giant checklist to help you do just that. You'll see all the usual suspects here. Things like what you spent on advertising, your business insurance, your office supplies, maybe the fees you paid your bookkeeper. It's all there. The form even gives you a specific line number for each category. This is exactly why organizing your receipts as you go throughout the year is such a game changer. Good record keeping isn't just a chore, it is your single best tool for making sure you claim everything you're entitled to. Now, while a lot of your expenses are 100% deductible, some of them come with special rules attached. And a perfect example, one that trips up a lot of people, is meals and entertainment. You can't just write off every single penny you spend taking clients out for coffee or lunch. There's a catch. Here's exactly how that rule works. Let's say Alex spent a total of $2,000 over the year on legitimate client meals. Well, the CRA rule says he can only deduct 50% of that amount. So when he fills out line 8523 on the form, the number he actually enters as a deduction is just $1,000. It's a small detail, but getting these little rules right is super important. Okay, let's take a deep breath. we're about to tackle what is, for many people, the most intimidating part of the T2125, capital cost allowance, or CCA. This is how you expense the big stuff, things you buy for your business that are meant to last, like equipment, furniture, or a vehicle. It sounds complex, but I promise, we're going to break it down. So what on earth is capital cost allowance? Think of it like this. If you buy a $2,000 laptop, deducting that entire cost in 1 year would make your income look artificially low. So instead, the CRA lets you write off a portion of its cost each year as the item gets older and loses value. Depreciation. They group different types of assets into classes, and each class has its own special rate for how much you can claim each year. Let's bring Alex back into the picture. This year, he bought a brand new, powerful laptop for his business. It cost him $2,500. Now, he can't just write this off as an office expense like he would with pens and paper. It's a capital asset. So how does he claim this major purchase correctly? All right, this table simplifies the big, scary chart you'll find on the actual form. Alex's laptop falls into what's called Class 50, which, luckily for him, has a very generous CCA rate of 55%. So for this year, his deduction is 55% of the laptop's cost, which works out to $1,375. The leftover amount, $1,125, has a special name, the undepreciated capital cost, or UCC. Just think of it as the remaining value that he'll carry forward to start his calculation with next year. Let's move on to a couple of the most common deductions out there for self-employed people, using your home and your personal car for business. The single most important principle to remember for both of these is that you can only deduct the business portion of your costs. It's all about separating business from personal. So like a lot of freelancers, Alex works from home. The rule is pretty straightforward. You can deduct expenses based on the percentage of your home that's used for your business. For Alex, his home office takes up exactly 15% of his apartment's total square footage. So he can add up all his eligible home costs. We're talking heat, electricity, insurance, even part of his rent, and then claim 15% of that total as a business expense. The exact same logic applies to his car. Now, this is where keeping a detailed mileage log is not just a suggestion, it's essential. You've got to have one. Alex tracked his driving and found that he drove 10,000 kilometers for business out of a total of 25,000 for the year. A quick calculation shows his business use is 40%. So if his total vehicle costs, fuel, insurance, the whole shebang, were $6,000, his allowable deduction is 40% of that, which comes out to $2,400. We are on the home stretch. We've figured out our income. We have tallied up all of our different expenses. Now it's time for the grand finale, putting it all together to calculate your net income or loss for the year. This is the bottom line, the number this has all been leading to. Let's walk through Alex's final calculation. We start with his gross income of $85,500. From that, we subtract his total regular expenses from Part 4. Let's say they all added up to $15,000. That includes his meals, supplies, that CCA for his laptop, and his vehicle costs. That leaves him with $70,500. The very last step is to subtract his business use of home expense, which gets its own special spot on the form. And there it is, the final number. After all the math, Alex's final net income for the year, the number he'll enter on line 9946, is $67,500. This is the piece that completes the puzzle. This is the amount of self-employment income that will flow directly onto his personal T1 tax return, and it's the figure that he will ultimately pay tax on. So let's just quickly recap the absolute must-knows. First, one T2125 for each business you run. Keep it clean. Second, records, records, records. I can't say it enough. Your records are your best friend. Third, pay close attention to the special rules for the big ticket items, CCA, your car, your home office. And finally, don't get overwhelmed. Just remember the simple, logical flow of the form. Income minus expenses equals your net income. Getting through your T2125 isn't just about getting your taxes done. It's like giving your business a comprehensive annual checkup. You get this incredibly clear picture of where your money came from and exactly where it all went. So the final question really has nothing to do with taxes. It's about looking forward. Now that you have this clarity, now that you know your numbers inside and out, what's the next big goal you're going to set for your business?